Paying tax on your Social Security can be a very frustrating reality when you don't apply the proper tax planning, certainly throughout your career, but even that tax sensitivity in retirement when you're on Social Security. I've got 3 strategies that you can use to reduce or even avoid the amount of tax that you pay on your Social Security. That and more coming up. The calculation of who pays taxes on their Social Security, that math that is done every single year when you do your taxes, that formula has not changed in decades. It is an enormous, enormous frustration. And what it means is every single year, more and more people are having to pay tax on their Social Security. I don't want you to have to. I want you to avoid this. I want you to be able to manage it. And the only hope that we have isn't that, well, maybe they'll change the formula someday. Maybe they'll eventually pass it where there's no tax on Social Security. I wish, right? They haven't been able to pass that. The only hope, I believe, is proper tax planning. Now, throughout your career, you need to be aware of this. I'm going to give you at the end of the video a few hints if you are not yet on Social Security or not yet at retirement, some things that you can be doing right now to put yourself in a better position to not pay tax on your Social Security out there in the future. But the angle I want to take really for this video is if you're already on Social Security, what are your options? What can you do right now to avoid or reduce the amount of tax that you pay on Social Security? If you're already on Social Security, if you're already retired, then you don't have other income. You can't contribute to a pre-tax IRA. You're likely on Medicare, so you can't contribute to an HSA. Those are a few very, very helpful options to reduce your adjusted gross income, and that would reduce the formula and improve the formula for calculating the tax on your Social Security. But let's say those are not options. What else can you do? What else is at your disposal from a tax planning standpoint to reduce the amount of your Social Security that's taxable? Well, I've got 3 ideas that may be appropriate depending on your situation, may not be appropriate for everyone, but depending on your unique and specific financial situation, any one of these 3 may apply. The first is using exchange traded funds within taxable accounts. That's right, using ETFs within taxable accounts. If you're not familiar, an exchange traded fund is a type of investment similar to a mutual fund, but it actually trades like a stock, right? Mutual funds trade at the end of the day, so it doesn't trade throughout the day, but also they tend to create some tax surprises for folks because they distribute capital gains. Conversely, exchange traded funds, very similar to mutual funds in that you own this one fund, but within it, underneath the hood, they hold a basket of investments. However, they trade like a stock all throughout the day and have special tax treatment where, yeah, they could distribute capital gain distributions, but most of them are very intentional so that they don't. Here's what capital gains distributions are. These are surprise taxable income that lands on your tax return without any forewarning and can very much wreak havoc on this calculation, the formula done to determine whether your Social Security is taxable. Have an example, an individual that I've been serving now for several years, but she came to us by about the time she retired and in her divorce had inherited 3 different mutual funds that had very, very low cost basis, sorry for the jargon there, but very, very low taxable cost basis and had a lot of gain on them. So at any time, if we were to sell these things, if she was to sell them, she'd have to pay tax on all of those gains. And so basically she said, we're going to build around it. And I said, yeah, that's fine. So she's continued to hold these 3 investments that were received in her divorce. So they're not inside of an IRA or a tax shelter. They're in a non-IRA account, a taxable account. And every single year, guys, these are mutual funds and they create an enormous tax surprise. How much capital gain distributions are each of these 3 funds going to distribute without her knowing and influence the taxation, the calculation for the tax on her Social Security? Each year we talk about this and her situation. Each year we do the calculus to say, do we rip the Band-Aid off? Do we sell any of these? And that's an individual decision that she and I make each year. But the point when you are trying to look at the structure of your investments, hopefully you have tax diversification. You've got dollars in pre-tax, dollars in Roth, and you might have some taxable dollars as well. The point is to set those taxable dollars up with very, very tax efficient investments such that you they don't create tax surprises that wreak havoc on your calculation of determining whether your Social Security is taxable. Idea number 2, strategy to reduce the amount or avoid completely how much tax you pay on your Social Security in retirement. You've got to be older than age 70 and a half to do this one, but that is doing your donations, doing your charitable giving through qualified charitable distributions. This is one of the most underutilized tax planning strategies for this stage of life. And this is where you pull dollars out of your IRA, but they're not taxable to you. They don't land on your tax return and therefore are not included in the calculation for whether your Social Security is taxable. Well, how does this work? If you are donating to charity, a 501c3, so this could be the church or other nonprofit, if you're donating to charity and you are over or have reached age 70 and a half, you can make that donation directly from your IRA via what's called a qualified charitable distribution. The money doesn't go to you and then to the charity. If so, that's taxable to you, and you're just hoping to get a deduction for your charitable contributions. If you itemize your taxes, or now starting in 2026, there's going to be a special above the line deduction, videos and content on that out there in the future. That's not what I'm talking about. That's a 2-step approach, and it does actually, that means that those dollars that you pull out of your IRA do count against you in that calculation for whether your Social Security is taxable. No. Instead of doing that, a qualified charitable distribution sends the money directly from the IRA, directly to that charity, directly to the church, directly to the nonprofit. And in doing so, the money comes out of your IRA, but it doesn't land as taxable on your tax return. And therefore, then there's no need to get a deduction for your charitable contribution. The money's already deducted anyway, and it doesn't count against you for that calculation of Social Security tax. And then third, and this one matters the most when it comes to avoiding tax or reducing the tax you pay on your Social Security, and that is having an integrated withdrawal strategy from your investments. I mentioned earlier, hopefully you're showing up in retirement and you've got some tax diversification. You've got dollars that are growing pre-tax that when you withdraw them, you're going to pay tax on them. These are things like traditional IRAs, maybe an old 401k, something like that. Hopefully you've got some dollars growing in a Roth IRA where you never got a tax benefit on the way in, and as you withdraw dollars, it's going to be tax-free to you. And then maybe, like I mentioned, you already have some non-IRA dollars, non-retirement dollars, some taxable dollars. Hopefully you have that level of tax diversification. Well, when you have that choice, you can do that proactive tax planning to determine on a year-by-year basis or even month-by-month basis where it makes the most sense for you to draw your retirement income from. Let me give you an example. Say in a particular year, you've got dollars where you're supplementing your Social Security and you're pulling it out of your IRA, meaning those dollars are going to be taxable to you. Well, if you structured it such that, well, I'm drawing it out at a level where, very little of my Social Security is being taxed or none of it is being taxed, but now you've got a new expense. Maybe you need a home repair. Maybe you need to buy another vehicle. Considering pulling those dollars for that special purpose out of the Roth or from some other cash reserves or from a taxable account so that you're not pulling dollars out of your IRA, adding more income, adding more dollars to that calculation of whether you're going to pay tax on your Social Security. Roth IRAs, taxable accounts, even cash reserves, these are extra resources at your disposal when you've got tax diversification that you can draw from that don't necessarily count as income on your tax return and can help you avoid or reduce the amount of tax you pay on your Social Security. So those are 3 ideas, depending on your situation, that can very much help in that calculation and reduce the amount of tax you pay on your Social Security. Now, if you're in your career and you say, I'm not going to be collecting Social Security or drawing Social Security for 5, 10, 15, 20 years, this same tension is going to be there when you retire. How much of your Social Security is taxable? Right now, as you're saving up and as you're, throughout your career, you can be intentional in how you save and the tax planning that you do to put yourself in a better position to pay no tax or little tax on your Social Security out there in retirement. Things like funding your Roth IRA or your Roth side of your 401k. It's got to make sense today in your financial situation, but having those dollars out there in the future where you can pull them out in retirement, they're not going to count against you in that calculation. Also, things like an HSA, in treating your HSA like a retirement vehicle where you're saving up in shoeboxing and then paying for your medical expenses today out of pocket so that you've got this big IOU that you walk into retirement with and say, well, I can pull 40 grand out from my Roth IRA and have it not be taxable. That's a great way also to help with this calculation. And then, as I mentioned, using exchange traded funds for non-retirement accounts, for those taxable accounts throughout your career as you're saving. If it makes sense for you to begin saving in a taxable account, setting it up intentionally so that your investments from the get-go are into exchange traded funds that don't have or are very intentional to not have surprise capital gains distributions, setting it up that way intentionally from the beginning can help avoid a lot of strife and avoid and reduce the tax you pay on your Social Security out there in the future. There you have it. Those are a few ideas that you can implement if you're on Social Security right now, as well as a few ideas you can implement throughout your career. Point is, work with your certified financial planner on those tax planning strategies. That's one of the 6 areas of your financial life to improve your retirement picture, another area of your financial life, all connected to your estate plan and your present financial position, your investments as well, your protection planning. All 6 areas of your financial life are integrated. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.